This is a grant program through Fannie Mae, and what they do is it's for first-time buyers, and that means you haven't owned anything in 3 years. Cool thing about this program, most of the down payment assistance programs, they have income restrictions. So if you make $300,000 a year, in most places, you're not going to be eligible for down payment assistance because you're over the income limits. And so the cool thing about this program is there's no income restriction on it. They waive all the income restrictions.
Hey everyone, welcome back to Prime Homes Orlando's podcast today. I have a real treat for you today. With me joining is Jon Smith, a seasoned mortgage expert with Guaranteed Rate. Jon isn't just a mortgage lender, he's someone I've had the pleasure to work with on multiple occasions. He's helped me and my clients make smart moves, smart decisions on their purchasing or on their selling side. It's been a real treat working with him, and he is with us today here sharing us his insights, his expert information to get you the mortgage you need or any financial advice you need. Jon, thank you for joining me.
Absolutely. Thanks for having me.
It's a pleasure for you to join us. I know you're a busy guy.
Yeah.
I'd like to jump in straight into the questions, unless you want to say something before we jump into the questions.
No, thanks for having me as part of this. And,
awesome, perfect.
Yeah, look forward to talking to you guys.
All right, so to bring real value to the viewers, I've prepared a list of questions, and hoping that they find value as well, and I want to learn as well. So my first question, Jon, is for first-time home buyers. If you're watching first-time home buyers, what's the smartest first step you can take in the mortgage process?
So that's great. There's a lot of first-time home buyers. The market for that is really opening up. And so I would just say that the best advice I could give is to maybe talk to a mortgage person or a financial person just to kind of figure out what you're working with. Do a loan application with somebody, have your credit checked, try to save up as much money as you possibly can. Try to keep your credit cards to a lower balance. Don't make any big purchases. But I'd say first and foremost, just talk to somebody. Not everybody is the same when it comes to their financial picture and what they want to make happen. And so talking to somebody just to kind of get a high-level view of where you currently stand at is the first step. So.
And you mentioned this overview. How long does that take to get a quick roadmap? So if I have a client who calls you, which I've done before, they usually know right away as to what path to take, which is very important in my eyes, because we're not the experts. You're the expert as far as money goes or finances goes, or what they can and cannot do. So I felt that has been very valuable to me and to my clients. The other day I had somebody reach out to you, and they were very happy after they talked to you because they're like, now I have a clear vision or a clear path to take.
Yeah.
So is it always that quick for you to decide, hey, take this road or take that road or take this path?
Yeah. So like I said, everybody's got a different, some are nice and easy, and within 5 or 10 minutes I can give somebody, good advice and they can be right on their way to doing something. Sometimes it takes a little bit longer, maybe somebody is self-employed and I have to review tax returns, or maybe they have a complicated situation in terms of credit where we need to get their credit fixed. I'd say most of the time, it just within a period of 10 to 15 minutes, we can determine, the best path to take.
Got it. So the first thing is to speak to somebody, an expert. Please call Jon Smith if you have any questions. You don't have to be working with me in order to talk to Jon. Put his contact on the description as well. Moving on to question number 2, interest rates, something that's in everybody's mind every single day. These things change. They have a huge impact on buying power. Can you explain how even a small rate change can affect a monthly payment?
Sure. So I did run a scenario actually for this. He provided me the questions ahead of time, so I know exactly what to say. So,
just so I know what value to bring,
I ran a scenario on a $400,000 purchase price with a 1 point difference in interest rate. So I assumed a 7.5% versus a 6.5% on an interest rate. And the principal and interest difference is about $268 a month for that 1 point difference. Yeah.
That's pretty significant. Yeah. So how does that impact as far as the purchase price goes? You ran a scenario for 400,000. Say it's an $800,000 home. How does that impact the buyer's decision-making process? Like, is that significant?
Yeah. I mean, so the difference would be roughly double, going from 400 to 800. The difference in the payments would be double.
So if today the interest rate was X, tomorrow it's Y, do you have to give a different answer tomorrow to the same person who inquired the day before, or how does that work?
Yeah, I mean, generally we won't see, the market does shift sometimes a couple times per day, but we normally won't see giant shifts in interest rates. So if somebody calls me today, chances are if I talk to them the next day, I'm not going to say, hey, the rates went up 1%, So generally speaking, interest rates are going to move there's going to be very incremental changes to the interest rates on a daily basis. So we shouldn't see giant shifts like that. Now, when I approve somebody, if it's a really close qualification, then I'm making sure that I tell them, hey, look, we got to be super careful. Every property you find, we have to check the taxes, the insurance, if there's association dues, we have to make sure that we are on top of the not only the change in the interest rate, but the change in those taxes, insurance, and HOA dues on every property to make sure that we don't push your approval too high and put us into a position to where we're not qualified anymore on the transaction. And again, this goes back to everybody's situation is different. Somebody that, I don't know, I'm going to be crazy. Somebody that makes $1 million per month is probably a little less concerned about their payment moving a couple bucks per month than somebody who's, maybe on Social Security or a pension or some sort of fixed income. So those are, again, two different situations where somebody may not care at all or very little, and then somebody who's very payment conscious, and we need to be very careful. Yeah.
Got it. Understood. That's excellent. Moving on to question number 3. Pre-approval, and I get this all the time, pre-approval versus pre-qualification. What's the difference, and why does pre-approval matter so much in today's market?
Yeah, so you probably see this on the listings that all of the offers must have a pre-approval letter attached to the offer.
Absolutely.
And so the difference between the two is that a pre-approval is much more involved compared to a pre-qualification. A pre-qualification is me just simply having a conversation with somebody and saying, what do you think your credit score is? How much debt do you have? How much money do you make? I'm relying on a lot of information from the consumer, and giving them an idea as to what I think they can qualify for. Now, contrast that with a pre-approval. When we issue a pre-approval, I'm verifying income, verifying assets. We're doing an actual credit check. And then we're also sending the loan through what's called an automated underwriting system. It's an AUS. And these automated systems, they analyze the file, the income, the debt, the credit score. And that automated system is actually issuing an approval. And so we don't issue a pre-approval letter until we've verified all this information and we've also received an approval through this automated underwriting system. So,
got it. So quickly, do you recommend people getting a pre-qualification first, or it depends on what part of the journey they are into the buying process?
If somebody is just kind of kicking the tires, and maybe not so serious about placing an offer, or maybe it's something they're thinking about doing in a year, then pre-qualification is fine. But if you are somebody that is serious about making an offer on a property, you should definitely get a pre-approval. And I'll give you an example. So I had a few years back, I had a gentleman that called me and wanted to buy a property. This is a guy that's an executive, wife was an attorney, when I initially talked to him, he said he was not concerned about getting approved at all. Very, very confident in his situation, and didn't want to do the approval. And so one night I get a call. He's like, hey, John, we found the perfect property. We want to put an offer in on it. So we actually did the application, ran the credit. And when we ran the credit, there was a derogatory piece of credit that had shown up. They had opened up a store credit card and just forgot that they did it, didn't make any payments, and their credit score dropped. And so it put them in a bad position where we couldn't get them approved initially. We had some stuff that we had to work out on their credit report before we could get the approval letter issued. And so they were, of course, not happy. They were devastated, because they had to work on this stuff. They found what they thought was their perfect house. And, it kind of took them back a few steps. And so that's why it's really important, if you're really serious about something, to just do the approval. Just knock it out.
Nobody wants to see an offer nowadays without a pre-qualification,
correct.
To be honest. And we've been through that before. Thank you. We're going to jump into question number 4. What's one common mistake buyers make when applying for a mortgage that could be easily avoided?
So I would say try to keep everything. When you apply for a mortgage, when I do somebody's application, I'm taking that information as of that time period. We're running the credit. You don't want to change anything. So no big life changes without at least having a conversation with whoever's doing your mortgage for you. And so
don't go buy a car.
Don't go buy a car. Don't change jobs. Don't close credit cards. Don't pay collections off. Don't do anything. If you're approved, you want to keep things as consistent as possible.
How about deposits?
So whenever you go through the loan process, we have to, we're going to ask for bank statements. And when we look at those bank statements, we're going to question, the underwriter is at liberty to question, depending on the type of loan, they could question certain deposits that go into the bank account. And all those have to be documented because we have to verify funds for closing. And so, if there's money that's coming in from other accounts, we can document all that. But what we don't want you to do is dig up the coffee can from the backyard that you had $10,000 buried in and plopping that into the bank account, because there's no way a lender.
Paper trail is
huge.
Is key.
Yeah.
And if I do have a coffee can in the back and I do take $10,000, there's a concept called seasoning. How long does the seasoning process have to, how long does someone have to wait for that coffee can to become legitimate in the bank accounts?
Great question. So 60 days.
60 days
is about average. Sometimes we get it where we only need to document 30 days, but I would just say 60 days is a safe time period.
Got it.
Yeah.
Awesome. Perfect. I had this happen to me a couple of times, so which is why I thought
it's a nightmare.
It is a nightmare.
It's a nightmare.
It is a nightmare. Moving to question number 5 with student loans, and I think this is important too. Student loans, debts. How can buyers make sure that they're still in a good position to qualify, even with those on their, on carrying them in their backs?
So, student loans, a lot of the people that I'm dealing with right now have loans that are in deferment, which means when I run the credit report, it shows that it's in deferment and it shows a 0 payment. Well, most of the agencies, Fannie Mae, Freddie Mac, FHA, VA, they all have a guideline on how much we have to hit the consumer with for a debt. So the way that the deferments work is you have to apply for the deferment every year. And so from a qualification standpoint, depending on the loan, we have to hit them with a payment on those student loans. And so if somebody owes $10,000 on a student loan, I'll have to hit them with anywhere from 0.5% to a full percent when we qualify them. So that's anywhere from a $50 to $100 payment on that $10,000 student loan. There is also something called an income-based repayment on a student loan that you can also apply for and get into. And again, depending on the loan product, I may be able to use the income-based repayment that's showing up,
which is offered through Guaranteed Rate. Is that a third party?
Well, we're following what's called agency guidelines. So we follow, Department of HUD, FHA, VA, Fannie Mae, Freddie Mac. So we're following those guidelines. So these agencies put out their guidelines, and we just follow them as a lender.
I see.
But in income, I've seen this many times before, where people go to apply for the income-based repayment program, and their true payment is 0. So if they're in an income-based repayment program and their payment is 0, we may be able to just not hit them with anything, again, depending on the loan product.
Understood.
So, yeah.
Awesome. Perfect. Question number 6 is a little interesting for me. For sellers who are planning to sell their home, how can offering assistance with closing costs make their property more appealing?
Sure. Yeah. I think, again, you hear me say this a lot. Everything is different. Like, one thing I think you could say in this business, which keeps it interesting for not only you but me, is that no two people are the same. No situation's the same.
Nothing's the same. Yeah.
So I think, like as a seller, if if you've listed your property for one day and you have 20 offers, you probably don't need to do very much to sell the property. Obviously, you've got all these offers. But I think in the market that we're in right now, and again, it depends on the property, but I think it's, maybe leaning more towards a buyer's market instead of a seller's market. And so I think if you have a property that's on the market for, 60, 90 days and, seller's getting antsy and, why isn't this thing sold? We need to get it sold. The cash being offered to assist a buyer is very helpful for a lot of people. A lot of people don't have, hundreds of thousands of dollars just saved up in their bank account to pay for down payment and closing costs. And so offering an incentive like that can oftentimes help move the property. And I think a lot of people are also competing with new construction sometimes. You see that a lot with new construction where the builders are going to offer an incentive, typically to use their lender where they pay closing fees, maybe offer a lower interest rate. And so those types of incentives will help you stick out in a market where maybe not every other seller is willing to offer those.
So you can get as creative as you want as far as the seller's end goes, and that could, qualify a buyer who's a little short past the, to get to the finish line, and they can come to a meeting of the minds and everything may work out.
Right.
Moving on to question number 7, let's talk about credit scores. What's the biggest factor that affects a buyer's score when they're applying for a mortgage? And I know you highlighted some of it before, but if you could point out the key things that would affect a buyer.
Yeah. So there's a few different things, really. I'd say the biggest thing is just pay your bills on time. Try not to be late on anything. When I got out of college, I got in trouble with credit cards, not understanding, my folks never talked to me about credit cards and what it meant, and I got one and I just thought I could ignore the bill. And I could, but
sure could.
When I went to buy my first car, they're like, yep, that'll be 20%. And I'm like,
holy crap.
Yeah. So, credit is just so important. And so you just don't ignore it. Try to talk to your credit card company or, the car loan company or whatever. And, if you're having trouble, try to work something out, but try to be on time with your payments. The other big thing is to try to keep your balances down. Versus your credit limit. So if you have a $1,000 credit card with a limit of $1,000, don't run it up all the way. Ideally, you want to keep it at like 30% of whatever the limit is to 30% maximize.
Constantly revolving every month, or do you recommend paying it off on time? Because I've heard that before, and based on my research, where credit card companies, people who are professional at this online, they recommend to build your credit, have like a 20 or 30% constant revolving history per month, and don't pay it off in full. Is that a thing, or is that like a...
Well, when you make a payment, so the credit bureaus get the information on what the balances are usually before you pay them off in full. And so, like when your statement comes out, it's going to be reported to the credit bureau. So don't ever owe more than, 30% of whatever the limit is. And I don't like interest. I mean, we give out loans, but interest is terrible, especially on credit cards now, 25, 26, 27, 28%. So I'm not a fan of carrying balances on credit cards. I use it to get the points and, just to run my household, it makes it easy to just have a credit card where you pay things off, and I just pay one bill at the end of the month.
And you're done.
But I always pay it off. My credit card company probably hates me because...
So you paid off in full. Jon Smith pays off his credit card in full.
100%.
And you're a mortgage expert, so 100%. I highly recommend doing that.
Don't pay 28% interest.
Thank you for that. Question number 8, are there any specific loan programs and or incentives out there for first-time home buyers that should know that are constantly available? for first-time home buyers?
Yeah. So there's a few that I like to work with. I'll mention just a couple of them. There's a new one that just came out a few months ago. It's through Fannie Mae. It's called Home Ready First.
Home Ready First.
Home Ready First. And this is a grant program through Fannie Mae. And what they do is it's for first-time buyers, and that means you haven't owned anything in 3 years. And the cool thing about this program, most of the down payment assistance programs, they have income restrictions. So, it depends on where you live and where you're buying and the area of the country and the state and all that good stuff. But, if you make $300,000 a year, in most places, you're not going to be eligible for down payment assistance because you're over the income limits. And so the cool thing about this program is there's no income restriction on it. They waive all the income restrictions. And what they do is they look at where you're living right now. And so, like we're in Orlando. So if you live at a particular address in Orlando, what we do is we look up the property address, see if you're within the designated area. And on that program, you could be eligible up to $8,500. Doesn't have to be paid back. You don't have to live in the property for a certain amount of time. It's free money. You get lower than market interest rates. So it's just a fantastic program.
But you said that you can't have owned anything in the last 3 years. Is that only in Florida, or can I be in New York and apply one for Florida, or is it like a nationwide?
Nationwide. If you've owned any property in the last 3 years, then you'd be ineligible for it.
And am I allowed to rent the property if I qualify for that loan?
So you have to move into it as a primary residence. But let's say you live there for a couple of years and you decide you want to buy something else. Rent it out and go buy something else.
Got it. Awesome. And anyone for a first-time home buyer can qualify. This depending on where they live, their situation, things like that.
Correct.
And again, there's no repayment needed for that loan.
Yeah. That's why I love it. Yeah.
Is there like a specific interest rate they fall into if you apply for that kind of loan?
So those rates are generally going to move with the market as well.
Okay.
So they're usually a quarter, 0.3% lower than whatever the going market rate is for any other type of loan product.
Got it.
So,
awesome. That's good information for first-time home buyers. Moving on to sellers. For sellers who are also looking to buy, what's the best way to handle timing a mortgage on their next home if they already own something?
So, again, this depends, right? So, if some people are in a really, really good situation in terms of income, and they can qualify for not only their current home, but also the new home as well. And so they may say, you know what, I'm going to ultimately sell my property, but I don't need to sell my current home until I buy my new one, and I don't want to get into like having to move out. And so some people will say, well, you know what, I want to qualify for the new property and I'll sell my other one whenever. Other folks may need the money from the sale of their property in order to purchase the new property. Or maybe it's a qualification thing. Maybe they're carrying too much debt and they can't afford to carry both mortgages at the same time. So there's a wide range of different scenarios that could play out. We do simultaneous closings, so we could set it up to where the property you're living in right now, you close in the morning and then you close on the new one in the afternoon.
Got it. I've had a couple of those happen. So
yeah, it's a little bit of a juggling act, but as long as all parties are communicating, and that's something that is pretty common.
Yeah, that's true, and we're pretty good at communicating between us, Coldwell Banker, between Guaranteed Rate and Sunbelt Title. The connection that we have is flawless.
Yeah.
I've never had an issue. Moving on to question number 10, our final question. It's not really a question, but I'm hoping that you could give our viewers a piece of advice for anyone who's looking to get into the mortgage market today. What would it be? I
would just say, don't be scared. Don't. So many people, especially first-time buyers that I talk to, are maybe a little bit intimidated about just the process and how it works and what they should do, but don't. That doesn't mean that you should not take the first step towards seeing what you can qualify for, seeing what you need to do. You're never going to figure out what you need to do unless you just talk to somebody and try to figure it out. And then once you figure it out, be involved. Take take a hold of the process and make sure that you're involved with things. So many times I get into this process with folks, and they're not really taking an active role and just being involved with the process. So when when we call and we ask for something,
answer the phone.
Try to send it right away.
So be proactive.
Being
basically,
proactive, just being proactive.
And I think that's a hurdle that just the industry faces in a whole general perspective. Even being a realtor, sometimes trying to get my seller or the buyer on the phone. Not that it's ever happened, but there's times where I needed things to be met at a certain deadline.
Yeah.
And they're busy. That is, everyone's busy in their own. Everybody has something going on. So
I always say buying a house is like having a second job.
Yeah.
But it's only like having a second job for 30 or 45 days.
Once it's done, the feeling is amazing. The feeling is amazing.
Yeah.
Well, now we're at the end of our questions. So I just want
bonus
to throw
round.
just a quick bonus round. And I did this to Vanessa as well, our managing broker. Question, coffee or tea?
Coffee.
If you had to open Netflix today, what is the first thing you're watching?
Well, if it's tonight, I'm going to watch the Tyson fight.
The Tyson fight, man, I can't wait. I can't wait to watch that. Who are you supporting?
I hope Tyson wins, man. I remember when I was growing up, it was good memories. Me and my dad would always watch the Tyson fights. And they never lasted very long. It's like we would pay this money to watch the pay-per-view fight, and it's like 30 seconds.
Yeah, that's true. You're like, holy crap. Money's worth.
You're like, you make sure don't go to the kitchen and get any snack, because it's going to be over by the time you get out.
Don't turn off the TV until you turn it off.
So I'm looking forward to it, but
it's new school versus old school. It's going to be an interesting fight.
It will. I mean, Tyson's he's getting up there, man.
He's been training.
50, what is he, 57 or 58 or something?
So he's past his, 55, mid-50s. I don't know.
My hope is that he just catches him with a good one, like in the first round, and it's over.
Embarrass the young guys. Yeah. That's true. Well,
what about
John,
you?
I'm supporting Tyson as well.
Okay, all right.
Yeah, I just, Jake Paul, he's a little bit,
He's wild.
He's wild.
He's a YouTuber, man.
Somebody's got to put him in his place,
I think so. Hopefully it happens.
Hopefully he never sees this either.
Yeah.
But yes.
Exactly.
Thank you for joining me. I hope you guys have found this helpful. If there's any questions you have about your mortgage, or if you're thinking about buying, or you simply want a consultation with Jon Smith, I'll put his information down there. If you can't get a hold of him, get a hold of me. I'll make sure he calls you back or reaches out to you. Again, if there's any questions, put them in the comments. Please like, share, and subscribe. And thank you, John. I appreciate your time.
Thank you.
Hopefully we can have you again soon. Thank you.
Let's do it.
Take care.